Hi, I'm Segun Lawson. I'm CEO of Thor Explorations Limited. Thor is a West Africa-focused gold producer with a producing mine in Nigeria and an advanced exploration project, the Douta project in Senegal.
Segun, very good to see you again. It's been a while since we've done an interview. Some good, some bad. You know, the gold price is up at 2160 or thereabouts. But you had a tough old year last year. Do you want to just kind of tell me about last year?
Yeah, look, last year, it's no secret, was our most challenging year as a company. It was always envisaged to be the most challenging year in the mine plan. So, you know, we're glad to have that done and under our belts. But, you know, look, we produced 85,000 odd ounces during the calendar year at a much higher all-in sustaining gold price than the previous year and in the years to come.
Sorry, at a much higher cost than the...
Sorry, at a much higher cost, all-in sustaining cost, because, you know, a lot of last year was... our activity last year was doing a lot of waste mining and pushing back a wall in order to have access and flexibility to high-quality ore for the subsequent years of the mine life. So look, operationally, you know, there was a lot of mining without, you know, producing gold. And we also took the opportunity to upgrade various bits of the plant, which also came at a cost in terms of a buildup of gold in circuit. So look, we're through that. We're through 2023. And, you know, what we can say is, you know, that adjustment from 2023 to 2024 is one that's a process, and you know, obviously Q1 has taken some adjusting to, but you know, we put out a guidance this year, the bottom end of 95,000 ounces, which we still stand by, and we see this year as a year of deleveraging completely from our senior debt facility, strengthening our balance sheet, and you know, delivering on production. Now, you know, it's a year where fortunately it's coincided with very strong gold prices, and delivering on our guidance, as we have said, will actually see the company start to build up a healthy amount of cash for the subsequent years of the mine life.
Great. Just kind of going back, let me unpick a little bit what happened. So in 2022, you produced, I think, 98,000 ounces. And then in 2023, you had this big pushback, which is where you take on more stripping in a single year so that the subsequent years of the pit can have a steady and kind of low strip ratio. Have I got that right?
That's completely right. You know, the ore body is a south plunging ore body, which means, you know, we started mining in the north, but as we go south, in order to get to the ore, we have to just take away a lot of earth without that didn't contain any gold, to put it quite simply. And in order to be able to mine efficiently for the remainder of the mine life, we needed to actually push back the western parts of the wall to make sure, you know, it was open enough and we'd have flexibility as we go down, you know, for the remainder of the mine life. So that's what we had to do last year.
And so it's just a kind of a feature in the course of a pit that just 1 year you've got this kind of, you just have to take it on the chin in that 1 year. You just have to take in that much more waste tonnage for the scheduling of the rest of the life of mine.
That's correct, yes. So, you know, as a result, our profitability last year, we don't expect to be at the levels of the year before. But now we've done that, we expect that profitability to start coming back, you know, going forward on an annual basis. And we believe there's still, you know, a lot of free cash flow to be generated out of this mine over the next 3 to 4 years.
You mentioned that you, I've got in my notes here kind of 84.6 thousand ounces. So you said kind of roughly 85, which that's the number that you produced last year. Is that what was mined, or was that what you sold?
No, that was what we produced.
Okay.
Sold was slightly less than that in terms of gold in transit and gold we had in inventory. But what we actually produced
out the back end of the kind of the sausage factory.
Was 84.6.
And when you talk about the gold, which is still locked up in the plant because you were doing all these plant modifications, are you talking a few hundred ounces, a few thousand ounces, 10,000 ounces?
Yeah, so we're looking at between 10 and 11,000 ounces, which we're also looking to draw down through the course of this year. So that also goes towards our our production target this year. If we can draw down at a quicker rate and have the throughput at a steady rate as well, we may even it may even be beneficial to us on a positive reconciliation side. But that's why we've given the guidance where it is. We think a combination of the drawdown plus the production should land us around about that 95 to 100,000 ounces.
Okay, so that guidance that you said earlier this year was 95,000 to 100,000. Okay, and that includes about 10 or 11,000, which was mined last year, but it's going to come out of the plant this year.
That's correct, yes.
Okay, great. And you talk about deleveraging your senior debt. What's that quantum?
So our initial senior debt was $54.5 million. We are making very good progress with that as per the schedule. There's $22 million left on that. We're making quite a large debt repayment at the end of March of $8 million. We're making another large repayment at the end of June. So through the course of this year, that senior debt will be completely repaid. And our balance sheet will be strengthened as we start to build up some more cash. We've given a cost guidance of $1,100 to $1,200 per ounce. So pulling down that golden circuit and producing, paying back the senior debt, strengthening our balance sheet, and then leaving us very well positioned for 3 to 4 years of strong free cash flow to come from the existing mine. And that's without even considering any potential exploration upside. One thing we are doing for Q2 this year is bringing forward some of the deeper drilling we were doing underneath Segilola. I don't know if you recall, this resource hasn't been closed out at depth. So we're hoping that now we're in a stronger position where we're not using a lot of our operational resource and focus and energy on pushing back the west wall and pushing back waste. We can redirect a lot of that focus into chasing the resource at depth. And given where the gold price is, there was always an underground component of this mine. Given where the gold price is, there is scope to deepen the pit and go even deeper in an open pit before transitioning to an underground. So these are some of the work streams that are coming up in Q2, and we will update the market with our at the same time as our quarterly our activities in terms of exploration.
So if I look at your all-in sustaining cost of between between $1,100 and $1,200, and look at the gold price today, which is between $2,100 and $2,200, you're effectively looking at about $1,000 margin per ounce. And 95,000 ounces, you add on the 3 noughts, and that's a pretty healthy sum. You pay off the $22 million of your debt, and so it really frees up capital for your exploration program, and also we'll address Senegal in a moment. But so that all brings me to the point of kind of looking at the end of life of mine of your pit, which presumably sometime in 2027, or is it in 2028?
2028.
Okay, so really what you're looking at now is using some of that free cash flow to add mine life, because with your capital paid off and your debt paid down, effectively there's huge value in additional ounces that you can delineate.
That's exactly right. I mean, if we take a base case of a further 3 years after this year of around about 100,000 ounces per year, no debt, let's even use this year's all-in sustaining cost of $1,100 to $1,200. We say there's a $1,000 margin or a $900 margin. There's still $300 million of free cash to be generated from the mine. And just from the initial exploration we've done, we know we're quietly optimistic and confident of extending the mine life further. So we think there's a huge value proposition anyway, as a base case. However, what we do want to start demonstrating, and that we don't need to have this mine closure in 2028. We do need to. We do believe that we can extend this mine life, and we're bringing that program forward. So, as you rightly say, a lot of our focus now is demonstrating that upside potential underneath the pit. We have been doing exploration around the pit, in and around the pit. We've had small wins, nothing I would call a home run yet, nothing of the sort of 200,000 ounce mark yet, but aggregating these various small deposits already, aggregates into something material in terms of annual production. So we will probably look to do some kind of study, at some point, probably towards the end of the year, and where we've seen, we can look at the economics of pulling these into the mine plan, or where the real focus is on extending the mine life is trying to look for those bigger numbers, 100, 200, 300,000 ounces. And our first point of call in that regard is underneath the pit.
They always say that the best place to look for gold is right next to an existing gold mine.
Exactly.
So just go underground, and access it with a decline. It's interesting. I've jotted down here before the interview your market capitalization, which is around $95 million. So you're effectively trading on 1 times cash flow. It's not all free this year. I understand that, but it's not 1 times free cash flow. But it's still a pretty punitive valuation. And I can see your share price was you were hammered, along with almost every other gold stock in the second half of last year. But you had the additional downdraft of a tough operating environment as you did the pushback and you'd spent money on the plant. But your share price was kind of 44 pence, and it's now kind of 26 pence. No, hang on, sorry. Sorry. I've got my cents and cents, and you're at 22 cents now.
Yeah.
And it was in the 40. I think it was 40-ish, wasn't it?
It hit 40 for a couple of days.
Yeah.
But yeah, look, it's no secret. It's a huge source of frustration for myself. I've got a lot of skin in the game, the board, management, a lot of our shareholders. But look, like I say, last year was a difficult year, and a lot of people have seen that. We produced compared to the previous year, we produced fewer ounces. We've generated less cash. But like I mentioned at the beginning of the call, this is what we see as a year of delivery, where we have to, after last year, hit our guidance. We've hit our guidance, in both years. It's a shame the guidance last year was where it was, but we've sunk that difficult capital in. We've carried out the difficult operations in terms of in-pit activity, where on top of the activities in the process plant, in terms of following the upgrade, being able to operate that and draw down the gold that's built up in circuit. And I think on our side as well, we are in an environment of very strong gold prices.
Yeah,
so
absolutely.
The gold price also helps the repayment of the debt, which is all gone this year. And like you said, if our market cap is where it is now, from next year onwards, we're literally valued at the same price as our free cash flow, which is very punitive. But any extensions to the mine life shows how undervalued we are at today's price. So look, we keep working away at it. We know the gold is there. We know we've been through the tough period, and we're now focused on delivering for our shareholders.
Well, and let's now talk about Senegal, because you've got the Douta project there. You're due a mineral resource estimate upgrade and a pre-feasibility study imminently. It was going to be the end of Q1, but I know how difficult these things are. We're kind of juggling lots of kind of different work streams. Can you just start off by reminding people where it is and what you've got in the resource already?
Okay, so we have an updated resource of the indicated component was about 900,000 ounces, about the same in the inferred component. What we did was we did a drilling program to infill that indicated resource, and when we kicked off our preliminary feasibility study work streams, we have had a longer than expected work stream on the metallurgy, which is proving to be more difficult than initially anticipated, which has meant we've had to push back this PFS, which won't be done this quarter, unfortunately. However, we are that work stream is ongoing. We hope to get it out as soon as practically possible after this quarter. I'll be able to give a more concrete time frame once we hear back from the lab as to the various labs we're using as to the confirmation of the flow sheet we're using. In the meantime, we know that the oxide material of the Duta project has been excellent in terms of recoveries as well. So we are kicking off a drill program there at the beginning of Q2 in a matter of days, actually, to drill out some more of the oxide targets, which will also add to the profitability and the commerciality of the project.
And it's in Senegal. Is it kind of a Massawa style mineralization? Is that the challenge? Is it the metallurgy of the sulfides that's proving tricky?
Yeah, so we're having tricky recoveries, and it's not uniform. That's what's making it even more tricky. It's not like, if we could say the deeper you go, the harder it is. It's different parts of the pit have been trickier on the recovery. Like I said, we're getting over 90% recovery in the oxide. We're getting close to right about 90% in the transition, and then some bits where you go deeper with the sulfides, like you say, we are finding it tricky. So look, we're sure we will have the process flow sheet finalized shortly. It has required sending bulk samples to different parts of the world, to Australia, for example, which has been very time consuming. And, the labs seem to be quite popular these days, so there has been a bit of a queue. But look, once we have that, hopefully we will have those results out as soon as possible.
Okay, good. When it comes to taking it on, presumably you'll go from a PFS kind of straight on, further studies. You'll have a kind of a board decision to make, and then you can kind of allocate capital towards Senegal for the Duta project.
Yeah, I think that's also one of the, should I say, if we could take a silver lining out of this long protracted PFS, is that it is going to be very detailed in terms of all the other ancillary studies, the engineering design, and so on. So if we do want to, or should I say, to transition from the PFS through to the bankable feasibility study, to get to those decisions by the board, it shouldn't be a protracted process from there onwards.
Good. And in terms of last year, you were, and possibly early 2022, you were kind of raising the lithium flag because you've kind of found some lithium stuff in your property. Has that gone quiet? Have you just parked that? What's the story with the lithium?
No, we haven't parked that. Look, we had some very encouraging initial drill results from the lithium. Subsequent to that, the drill results weren't really on a standalone basis worthy of should I say, press releasing. So what we have done is, prior to drilling, we've actually continued with our land acquisition. We've been generating on a soil sampling basis and auger basis a number of drill targets that wouldn't end up being, drilling a target and then waiting for a long period of time. So what we're actually going to do in Q2 is restart the drilling on the lithium targets. We'll have a presentation showing where we're going, and then this is over a number of targets. So we have steady news flow with a pathway to a critical mass, should I say, of drilling. And we expect that drilling to start in Q2. So there will be more lithium news flow. It's taken we've done it at a slower pace, enabled us to drill targets or define targets we're more confident on. And in the period, should I say, what's happened with the lithium prices has also meant that we can afford to take a bit longer. So certainly the lithium hasn't been parked. It hasn't been put to the side. It's just been done in a more comprehensive manner, should I say. The drilling is commencing in Q2, and we will hope to have news flow out on a steady basis on that drilling to the market from then onwards.
Good. And just so we've kind of touched on the strategic approach to Senegal and the drilling in the lithium. Just coming back to the exploration around Segilola itself and the deeper exploration. You mentioned that you've got some kind of bits and bobs in the satellites. Satellite discoveries, I think Kola and Ijorigbe are the kind of the names that you've mentioned. how are you approaching that? You've got 2 rigs kind of drilling deep underground and kind of 1 rig on the north and south in the terms of the satellites. Or what's the division and the budget both in terms of meters and money?
Yeah, so we finished the drilling at Kola. Like I say, it wasn't quite a slam dunk, but there are ounces there. What we want to announce to the market is significant ounces. So right now the plan is in Q2 we will have 2 rigs on the deeper drilling, and then we will have a rig scouting on various targets in and around Segilola. So there'll be 3 rigs in total. We've allocated a budget of $4 million as a first pass, and then following that, we will see where we go in terms of that drilling. That should get us, between 5 and 8,000 meters, depending on the depth of the hole we're looking to drill.
Good, thank you. Now you're listed both in on the Vancouver Exchange, the Toronto Venture Exchange, and also in London. Are you on AIM?
Yes.
Can you tell me a bit about those markets, the receptions? How responsive is it, and liquidity, and just kind of what's your feel from those 2 markets?
Look, I think the arbitrage, if there's any arbitrage between the 2, is quickly corrected in terms of if there's big selling in Toronto and the price goes down, it's quickly corrected the next day in AIM and vice versa. So they have been quite responsive. The sentiment towards the sentiment as shown in the share price, I think is based on the production last year and the difficulties we had last year. So as I call this the year of delivery, I do expect the share price to correspondingly respond to our delivery. We are seeing, probably for the first time over the last couple of months, volumes on AIM have overtaken the volumes on the TSXV, but we are seeing increased volumes on both exchanges as well.
Yeah, well, I think when you're a producing company and you're in a commodity like gold and there's this resurgence, I think the volumes do come. Liquidity comes with, well, it'll particularly come with delivery. If you can get price action, I think that'll stimulate liquidity.
Yes, I think so.
Well, Segun, thank you very much for the update. Go get them. Find gold, produce gold.
Yes, that's the plan. So we look forward to updating you again very soon with some good news.
Yeah, and I look forward to the Duta PFS. It'll be make for interesting reading.
Thank you.
Thanks.
All right. Cheers, Merlin.